I'm very pleased to welcome back to the show Jeff Olin, Vision Capital. Let me just tell you a little story about Vision Capital, because I was doing the review of exactly how their performance has been since their inception, going back, I'm trying to think how many years ago. It was a number of years. I've got it right here on my screen. But I think when you look at from 2008, I think it was July, it was the date when they formed. And I looked at the total returns, and we've had, pretty darn good stock market lately. So you look at the S&P and the TSX, their REIT index, for example. Well, it's up 114%, not bad. Vision Capital up 241% up to the end of February. TSE Composite, it's only up 42%. Vision Capital's up 241% since that time. It's 2008 through to February of this year. Jeff Olin is the co-founder of Vision Capital. Jeff, can we just say in a quick nutshell what you do? I always sort of describe to people that these guys have found a way to buy real estate, be in the real estate sector. They play it both to go up and to go down, but they do it in a way that's interesting, because if they want to buy something, they can get it at a discount.
Right. We focus on real estate through buying securities in the stock market. So we buy equities and debt, and as you indicated, we can be short, we can be long or short. So the reason we do what we do is we have the opportunity selectively to buy real estate cheaper in the stock market than the property market by focusing on the underlying net asset value, what's the real estate worth in the property market, and then comparing it to the trading price in the stock market. And the other side, if valuations are excessive or fundamentals are negative, we can be short, where you can't short an office building or an apartment building or a shopping center. Yeah,
the other thing that I'd like you just to explain to our audience again is that you don't get, you're not overly focused, for example, on total return and high yield. And in fact, I know I've read things by you that you say that actually could be a red flag.
Yeah, just to clarify, we are focused on total return. We're not
total return,
on yield. So, yield, as I might have mentioned before to you, I don't know any business in any industry where anybody looked at how much cash flow somebody was going to pay you in terms of a dividend as opposed to how much that business was earning tomorrow, not yesterday. And so yield can be a red flag. In fact, the Ontario Securities Commission recently stimulated an industry group in the real estate sector called RealPAC to improve their disclosure rules to investors, because there's a lot of problems hidden by paying yield, and investors generally, retail investors particularly, are seduced by yield, whereas you got one number of the things that we invest in have low or no dividends, and this is real estate. It's relatively easy to value, and it's the underlying value of the properties that matters, not how much somebody's paying you as a dividend, and often overpaying you to seduce you to buy their stock.
The other thing, that when I first started following you, and it was about 8-9 years ago, the thing that I liked was that you could be short real estate, because I was certainly in the view that we were going to have some real cyclical problems there. And I'm just thinking, when I think of that, I think how well you've done in the Calgary commercial market, playing it to actually go down.
Yeah, exactly. We looked out 2013, and we saw too many office buildings being built, so too much supply in the context of a secular reduction in demand. We don't need as much office space. There's no more law libraries. Deloitte & Touche just built new buildings in Toronto, Montreal, no offices for partners, no desks. You come in, you empty your briefcase on a table, the next day you got somewhere else. So, when I was building office buildings in the 90s, we built them 250, 300 square feet per employee. Now you're down to about 150. So too much supply, secular reduction in demand. So we've been short office for about 4 years.
And done well with it, though, is what I'm saying.
Done very well, yeah.
Does that extend across the country or across the U.S.? Because you do lots of work in the U.S., which, again, was a check mark for us on Money Talks, because I wanted some U.S. dollar exposure. We're still bullish on the U.S. dollar on Money Talks. But can you have pockets, for example? Obviously, you're going to be geographically specific when you're making the investment. But is it just a broad brush there? You're telling me that the Canadian office game has changed.
Great question. Yes, we do focus by property type and geographic region. So every office market in Canada is pretty much overbuilt, except the financial core in Toronto. The core of Toronto is in pretty good shape. The suburbs, not so much. U.S., it's generally more healthy. Downtowns are better than suburbs. We like New York, Manhattan office right now, and that's the advantage of what we do. I mean, if you go back to your Alberta question, we went from being bullish Alberta to bearish in Alberta in 2 weeks when the oil prices and political situation changed. You own a lot of real estate, or you own a real estate fund that owns a lot of bricks and mortar, you can't do that. You can't have that liquidity.
Yeah. And so let me go. I'm going to get to ask a couple of specific ideas from Jeff Olin, co-founder of Vision Capital, in a moment. I just want to give another couple of broad categories that you could maybe comment on for me, Jeff. Let's get to industrial. Industrial's not the same as office commercial. So what's your kind of broad view on industrial?
Yeah, it relates to our bearishness on retail. The pall on retail, the advent of e-commerce, all of the stuff, the headlines you read every day about bankruptcies in retail and challenges in retail are benefiting industrial. E-commerce activity is a boom for industrial logistics space. To give you one soundbite, you need 3 square feet of industrial warehouse space to service an e-commerce retailer relative every 1 square feet you needed to service a bricks and mortar retailer. I mean, the stock keeping units in bricks and mortar, they're kept in the store. In e-commerce, they're kept in the warehouse. Returns, bricks and mortar, done in a store. Returns in e-commerce, done in the warehouse. The warehouse for store, they have pallets. Warehouse for e-commerce has packets. And so there's been a big boon for the Amazons in the world in industrial. We like that space. And you're seeing rent growth for the first time in a decade, for example, in the GTA in industrial space.
How would you how would an investor invest in that? See, one of the things I like about Vision Capital is that there's a couple of real estate ideas I had. For example, I'm not a fan of malls, and the same reason Jeff is just talking about there. Look at you hear Sears going down, JCPenney with problems, Macy's with problems. I mean, the list just keeps going on. We've lost Woodward's, we've lost Eaton's. Chronicled that with Michael Levy many times over the years. So I don't like malls. Well, I try to figure out how do I play that, though. Well, that's what I liked about the ability of Vision Capital.
So industrial, we have, in Toronto, not in Toronto, in Canada, primarily focused in BC and Ontario. Pure Industrial REIT, AAR, is a great name. In the U.S., or it's not U.S., it's global, we have Prologis, PLD, and the New York Stock Exchange. They're the largest $30 billion logistics industrial company in the world. So those are 2 quality names that your investors could look at for exposure to the industrial logistics space.
Very quickly, can I come back on retirement residences? I just talked about healthcare and the aging population at the outset of the show, so that's why I'm thinking of that.
Yeah, absolutely. I mean, this is, it's got a lot of headlines this week, but this ain't news. I mean,
yeah.
Leading edge of the baby boom turned 65 in 2011. We've been on this trend for 20 years. It's going to continue. We like the retirement space in Canada. We're cautious in the U.S. Too much regulatory change, volatility, insurance companies, litigation in the U.S., and too much supply. In Canada, we like Chartwell. We like Sienna. 2 quality names, and you're going to see long-term growth there. New development makes sense, and again, you got to watch supply, which we do. But those are 2 quality names: Chartwell CSH and Sienna SIA, both traded here in Canada. I'm
talking with Jeff Olin. He is co-founder of Vision Capital, which you can find at visioncap.ca, visioncap.ca. I got to take a break. When I come back, I'm going to ask him for a few more picks. I love it when Jeff gives me the lowdown on what's going on in the real estate market throughout North America, both U.S. and Canadian sides of the border. We'll do that when we come back on the Money Talks Network. Jeff Olin is my guest. He is the co-founder of Vision Capital. What a great job they do at Vision Capital in that I love this, they choose. On the stock market, you see asset values that are discounted from if you had to go out and buy it on your own there. But they play the market to go both up and down in different areas. They do it geographically across North America. Jeff, just before the break, you were talking to us about being positive on retirement residences and healthcare in Canada. Can I get you to give some other picks at this point?
Sure, we continue to be constructive on apartments on both sides of the border. Similar to seniors, you got powerful secular demographic trends with the millennials tending to be renters versus buyers, and so we like apartments. Our largest holding is actually a Canadian REIT with all its properties in the U.S., pure multifamily REIT, symbol RUF, trades in Canada, both in Canadian and U.S. dollars, but it's all driven by the U.S. This is a high-quality Class A apartments focused in the Sun Belt. Over 60% of their income is driven by Dallas. They produce more jobs in Dallas in 2015 than the whole country of Canada. So we like that name. It's got a nice yield, 5.5%. It's trading around 680 US, and we think it's worth 820. So that's a great name in our view. Stable, sleep at night, and managed out of an executive team right there in your hometown in Vancouver.
It's interesting. As I say, I like the idea that you go around North America. You get the currency exposure. That must have done well for your investors, too, by the way, when you're playing some of this stuff. Talk to us about a couple of others.
Sure. The Howard Hughes Corporation. This is a $5 billion New York Stock Exchange listed company. Absolute perfect example of what Vision does. $5 billion New York Stock Exchange, no yield, no dividends. So the REIT mafia in the U.S., the institutions, they don't follow it, they don't own it. Incredibly high quality properties. Bill Ackman, by the way, owns about 30% of this. It's worth, in our view, or forget our view, the consensus view that those it's covered is about $170 US, trading at $121 US. And new CFO, new investor relations, incredible assets, a lot of upside in the Seaport district in Lower Manhattan. They have the Woodlands in Houston, which it's a master plan community. It's really a city, 100,000 people there. So that's a great name. We're short U.S. CMBS debt with exposure to retail and suburban office. So that's our play on the negative retail. GGP, this is the finest malls, so we're not very positive on retail, but these are, think the finest malls in Vancouver and Toronto and translate it to the best in the U.S. It's worth about $33 US, trading at 22, and Brookfield owns about a third of it. We think Brookfield may take the opportunity to look at this discount to with some partners, take over and privatize that entity. So those are a number of catalysts there that, notwithstanding our generally negative view on retail, we don't think it's going to hit the best malls. And a little speculative play for your listeners. European situation is improving. There's a very early stage company called European Commercial Real Estate, symbol is ERE in Toronto. It's got a nice yield of anticipated about 7%. They've got 2 buildings, but it's sponsored by very high quality people. The CEO of CapREIT, Canada's largest apartment REIT, and some of his colleagues have sponsored this. And so we think it's a high growth, early stage, more speculative. But those that sort of like to play more junior speculative situations, that's one they could look at in contrast to the multi-billion-dollar names I mentioned earlier.
I like, excuse me, because again, I get that it explains what you do at Vision, is you're shorting some of the weak credit of non-U.S. Sort of gateway commercial real estate. I just think that's a great example of, I think, the added strategies that you use to improve the yield within your own fund. I agree. I mean, there's a real opportunity there. There's going to be some problems, as you say, but at the same time, you turn around and say, not every place is going to have a problem. There are some world-class kind of retail mall properties, and you're sort of exposed there through GGP, as you said.
Yeah, I mean, the underwriting standards in the time frame of 2006, 2007, where all these investment banks were pumping out this CMBS debt because buyers wanted it, so they just left all their underwriting standards at home. So you've got values that are not going to be able to sustain when these mortgages mature this year. I mean, one of the things we like about this trade is we have certainty and realization this year, and it's not like other stocks where we think it's worth 10 and it's trading at 6, and not only do we have to be right, but then you have to figure out how you're going to get from 6 to 10. In this case, we're going to know these loans are getting paid off or they're not. And so we like that situation, and that we're going to have clarity this year.
Only got a minute or so left. Can I just get a quick comment? I'm looking at what's going on in Ontario, with their 16-point plan, and out in British Columbia, we've got various parties in a provincial election right now. And I look at this idea that they want to slow down residential real estate, and I think that it's not such a straightforward kind of view.
No, there's going to be problems here. Again, they might have some success through moral suasion in the single-family residential market. That remains to be seen. The vacancy tax, I like that as a resident, not necessarily economically, but I looked at Vancouver, and, my cousin lives out there, and there's 12 houses in his block, and 8 of them are empty. That's weird. So the opportunity for the local communities to consider that just as a community member is interesting. But what's really going to hurt, what was really dumb in our view, is their approach to rent controls. They put rent controls on post-1991 in condos for the first time. The combination of that and 15% buyer's tax is going to have the opposite result of what they're trying to do. You're going to reduce the supply of condos. You're going to severely reduce the supply of purpose-built residential. It's a boon to the REITs because the REITs don't have post-1991. They're not going to be impacted. And so you're going to see the only way that people can increase rents now is on turnover. So turnover is going to come down, but apartment owners are going to be more selective of who they rent to. Seniors will be hurt. You're going to have more smaller units that turn over more quickly. So it's the wrong thing to do. Rent controls have never worked anywhere. They ain't going to work here, and they'll just lead to more controls and more shortages and higher rents.
Jeff, we've got to leave it there, but I thank you so much. I appreciate you finding time for us on Money Talks. Vision Capital, visioncap.ca.